Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss how and when to utilize trusts in retirement. Specifically, I'm going to chat about the basics of trusts, common applications for trusts established during your lifetime, considerations for high net worth individuals, families, and business owners, establishing a trust in your estate documents, 4 crucial tax considerations, building a team to complete a cost-benefit analysis before establishing a trust, and lastly, as always, a few action items for you to consider. Over the course of my career, I have helped individuals and families establish trusts, whether it be to help with the transition of the sale of a business, to protect assets in a blended family, or to help define a testamentary trust that will be documented in the will. During my career, I've also talked a number of people out of establishing trusts altogether, as their situation truly did not warrant such a complex and expensive strategy. Oftentimes, I think people associate the use of trusts with wealthy people and may think to themselves that, hey, we should probably establish a trust too, without truly understanding the nuances of how and why these are established. So today, I want to give you a basic understanding of different kinds of trusts and the scenarios that families would consider such a structure. Each trust I will discuss has its own specific nuances, and some are sensitive to province and the territory in which you reside. I will do my best to keep things general and educational and give you the framework to help answer the question, do I actually need a trust? So to start, what is a trust? At its core, a trust is a mechanism by which assets can be held by a person for the benefit of another person, dependent on certain conditions. Instead of transferring an asset directly to a recipient with no conditions, an asset can be held in trust, meaning that they will receive a benefit under certain conditions. The person who creates the trust is called the settlor. The person who holds legal title over the assets is called the trustee, and the person who will receive the assets is called the beneficiary. If a trust is created during your lifetime, it is referred to as an inter vivos trust. There are many different types of these trusts, including spousal trusts, family trust, alter ego trust, and more. Income generated within an inter vivos trust is taxed at the highest marginal tax rate, unlike income generated personally that is taxed at graduated rates. These kinds of trusts also have a relatively high cost to create and maintain. So with trusts being taxed at the highest tax rate and the high cost of establishing and maintaining, when a cost-benefit analysis is completed, for most people, it makes more sense to keep things simple and not introduce a trust. That said, for high net worth families or those who are incorporated business owners, the use of a family trust is frequently used. In the context of a business owner, this is typically a part of a broader succession and estate freeze plan, but more on that in a little bit. Typically, individuals will create an inter vivos trust in an attempt to transfer income that might otherwise be taxed in their hands to a person or entity that's in a lower tax bracket. If that is your pursuit, you must be careful of attribution rules. This means that if not established properly, income and potentially capital gains from the trust would actually be attributed back to the settlor. Examples where attribution may apply is in the event you transferred assets to a trust where your spouse or common law partner is a beneficiary. In this case, any income or capital gains will be attributed back to you. If the trust itself is discretionary, meaning the trustee has the ability to decide when and how much income or capital the beneficiary will receive, attribution rules will likely apply as well. If you transferred assets to a trust that named a related minor, all of the income will be attributed back to you, even if it was paid to the minor. That said, capital gains are not attributed back to you. This may pose itself as a potential strategy called an age 40 trust. This is a trust structure that can be set up for a minor with the condition that they are not receiving the assets until some point in the future and no later than age 40. The trust also needs to be non-discretionary in nature, meaning the beneficiary is entitled to receive all the income every year, but it is to be held in trust as previously mentioned. If these conditions are satisfied, then the income can be taxed in the hands of the beneficiary each year until they turn 21, even though it is not paid to them directly. So, assuming the beneficiary is in a low tax bracket, the income is taxed in their hands even though the assets themselves will remain in the trust. So in this case, one such strategy could be to utilize an investment within the trust that generates minimal interest, dividends, or rental income. Rather, focus the trust investment on a solution with minimal distributions and is tilted towards deferred growth. Each year, trigger capital gains within the trust to fully use the young beneficiary's personal tax credits. In this way, the adjusted cost base of the trust's investment portfolio can be increased over time, so that when the beneficiary receives the funds at age 40, there may be little, if any, tax liability with cashing in the investments. Before you consider this kind of structure, consider maximizing registered education savings plans, RESPs, for your kids and grandkids, or perhaps helping them top up their tax-free savings accounts or first home savings accounts if they are over 18. That said, there will be a loss of control of the funds, but more often than not, these avenues should be considered before establishing a trust. So again, these kinds of trusts may be appropriate in limited situations, while they are not as common as family trusts. So let's talk about those next. Family trust isn't a legal term, it's merely a way of describing the trust. These trusts are discretionary in nature, meaning the trustees have control over which beneficiaries receive the income or capital, when they receive it, and how much. Some high net worth families may consider this kind of trust for income splitting purposes with low income family members by lending funds to the trust at the prescribed rate set out by CRA in order to avoid attribution rules. Typically, this kind of planning takes place upon a liquidation event like the sale of a property or shares. These families typically have high net worths, upwards of $5 million or more, and have sufficient capital for their retirement and lifestyle, and choose to loan a few $1,000,000 to the trust at a prescribed rate to income split with lower income family members. The most common use of the family trust, however, is when your intent is to transfer your business to your family, or you anticipate selling your business at some point in the future. This is when the use of an estate freeze and the potential use of a family trust can come into play. I will do a separate podcast episode on estate freezes for business owners in the future to get a bit deeper into this topic. So for today, I'll just discuss it at a high level so you know what it looks like. The primary purpose of an estate freeze is to freeze the value of the business that is accrued in the name of the original owner and allow for future value to grow in the name of someone else, typically the next generation. In some scenarios where it makes sense to establish a family trust as a part of an estate freeze strategy, rather than transferring shares directly to your family member, the shares are issued in trust in order to maintain voting control of the company and discretionary control over the distribution of income or capital from the trust. This structure can also multiply the lifetime capital gains exemption for a qualified small business corporation if the business was sold to a non-arm's length third party. This is a little over $1 million in capital gains exemption for each shareholder who have held the shares either directly or in a trust for 24 months. There are a large number of nuances to this strategy, which I will dedicate a future episode towards. But for now, let's just leave things there. So we've talked about a trust being created during your lifetime. The other kind of trust is created at time of death. These are typically created in a will and come into effect when the settlor dies. The core reason these trust structures are used are to control funds and for tax savings. Here are some scenarios where a testamentary trust may be a part of your estate plan. Number 1, you have beneficiaries in your will who are minors, and you want to control when they receive the money and ensure they are mature enough to manage it. Now, in my case, my wife and I have 3 children, and in our wills, we've named legal guardians and trustees. These trustees would manage the estate assets as a fiduciary for the benefit of our children. Specifically, we have named dates and milestones when money would be distributed. So, for example, you could say, age 25, they'll receive 50% of their inheritance, and at age 30, another 50% of their inheritance, or specific wording like when they go to school, there's some funds available. Now, without this specific wording, our children would actually receive their full inheritance at age 18, which could have very negative impact on them. In the scenarios we come across, we often suggest this kind of wording when there are minor children, grandchildren, or in the case an adult child with mental health or addiction issues would be a beneficiary. This kind of wording is done as a means to protect them and maintain some control over how the assets and money would be distributed. The second common use of a trust in your will is when you leave money to an adult child, but you want to ensure to the extent possible that the capital is preserved in the event of their relationship breakdown. Another case to establish a trust in your will is if you are in a blended family relationship and you want to ensure your spouse or common law partner is cared for, but still want to ensure something is left for your children from your previous relationship at the last spouse's passing. And another potential scenario is when you have a child with a disability who you would like to leave a portion of your estate and want to ensure they continue to receive social assistance and maximize tax benefits. This kind of testamentary trust is often referred to as a Henson trust, and depending on how they are structured, they may also be considered a qualified disability trust. If certain conditions are met, this trust would benefit from graduated tax rates rather than being taxed at the highest marginal rate. So I've covered off a number of inter vivos and testamentary trust structures today, and I helped to at least narrow down the answer, or the question I asked rather. Do I actually need a trust? For many, that answer may actually be yes, specifically the creation of a testamentary trust in your will when naming minors as a beneficiary. Now, before I shift gears into action items, I want to briefly mention a number of significant tax considerations that you should be aware of with regards to trusts. The first is that any assets you transfer into a trust will be deemed disposed of. In English, if you transfer an asset into a trust, any unrealized capital gains or losses will be triggered and potential taxes owing. Second, any assets held within the trust must also be deemed disposed of every 21 years, meaning that there will likely be a pending capital gain tax liability that will automatically be triggered on the 21st anniversary of the trust. Third is attribution, which is worth mentioning again. Many people assume they can just shift money to another person or trust and that all the future income is taxable to that person or trust. This is simply not the case if you do not structure the transfer of property correctly. Lastly is cost. Many of these strategies I discussed today have a setup and ongoing cost associated with them. If you're considering such an arrangement, be sure to discuss it with your financial planner, tax accountant, and lawyer. A team like ours can help sort through the cost-benefit analysis of implementing the strategies discussed. Having a coordinated approach with all of your professionals will ensure you have a solution and strategy that aligns with your intended outcomes for the betterment of your family and to help disinherit the CRA. Okay, that'll do it for today. Here are your action items for today's episode. First off, be sure to leave me a comment if there are topics you want me to cover. I received a message a while back from a Spotify listener named World Rider who was wanting my perspective on trusts. It's great to hear back from my audience, and it helps me to ensure the content I create benefits the demographic of people that want to listen to my show. So, World Rider, thanks for the comment, and stay tuned for my estate freeze discussion for business owners. Next, one of the most common applications is a testamentary trust outlined in your will. If you have minor children or grandchildren as beneficiaries, consider the impact a large inheritance would have on them at age 18. Would they be able to handle the funds responsibly, or should safeguards and controls be set up to protect them? Lastly, to be very upfront, other than testamentary trusts, most people don't need them. There are other planning strategies that should be fully utilized before you jump into creating a trust. Chances are it won't make sense. However, if you have amassed a substantial net worth, are the owner of a business, or have had a recent liquidity event, exploring your options and creating a unified approach may lead to the creation of a trust. As we go through our fundamental retirement plan with prospective clients, we weigh the value of such an arrangement and proactively bring forward suitable solutions to help ensure the strategies being implemented align with your intent. All right, so that'll do it for today. Make sure that you've added us on all of your socials, LinkedIn and Facebook. If you're enjoying the show, please subscribe and leave us a 5-star review in your favorite podcast app. Be sure you're signed up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.